In this fifth and final episode of this five-part series, Tom Fox and Vince Walden take a look at some compliance wins using data analytics. I know you'll enjoy this episode. Hello, everyone. Tom Fox back again with Vince Walden for the concluding episode in our five-part series. First of all, welcome back, Vince.
Glad to be back, Tom. Thank you.
Vince, today I wanted to maybe conclude our series by taking a look at some data-driven compliance wins and success stories. So where do you want to start?
Man, there are so many stories around finding hidden money and keeping the business out of trouble. And let's do a mix-up of a couple of those. Maybe I'll start with the finding hidden money, because that's really where not only the compliance professionals, but the CFOs and the heads of operations in the business really get fired up and really like the results. Let's start with a couple of those examples. First off, this one is a global automotive OEM manufacturer. It was sponsored by a chief compliance officer and the head of internal audit, where they were doing transaction monitoring over their third-party vendors and their employees' travel and entertainment expenses. But because we were processing all their vendor and third-party data and running it through libraries of hundreds of tests, there was also opportunities to tweak those tests slightly and look at finance topics such as working capital and such as unit price analysis. So in addition to the compliance monitoring and looking for high risk or potentially improper payments, they also looked at unit price analysis. And there's some really good OCR technology right now that allows companies to get to the unit price detail of the invoices. Again, most accounting systems and most compliance professionals, you can't get to the invoice unless you physically go and chase it down. And you'd only do that in an investigation. But nowadays, you can risk score the transactions and then pull in the PDF images of invoices or purchase orders, and you can see the line item details. So in this case, if I'm charging you 5 cents for a bolt or some widget, but for that same product ID, I'm charging you 7.5 cents or 10 cents for that same product or unit, but just in a different location or country by the same vendor, hey, I want that money back. I want that 2.5 or 2 cent spread. And that can translate into hundreds of thousands of dollars in recoveries if it's been multiplied by tens of thousands or hundreds of thousands of units. So it's been pretty exciting. In those cases, you're able to do kind of unit pricing, and I call that contract compliance, where the purchase order says, here's the amount that we'll pay. Does the invoice match that amount? And if it doesn't, you can go back to that third-party vendor and demand the price adjustment or credit in the future. And that's pretty exciting in terms of a win from finding hidden money. Now, that's not fraud. That's not abuse. It's not really compliance, but this compliance monitoring tool can also benefit performance improvement practices such as that. I don't know. What are your thoughts, Tom? Have you ever seen those people do those types of tests?
Vince, I've tried to, throughout this series, talk about my view that effective compliance equates to more efficient business performance, equates to greater profitability and greater ROI. And though that story really drives home that message, and I'd like to tell you one of my favorite compliance wins. And it started off really more in your direct wheelhouse of fraud and a fraud investigation, but it really was compliance as well. And the outcome demonstrated to me the power of looking at numbers and giving you greater business efficiency. And it went along the lines of something like this. Company had a high-risk business unit in a high-risk FCPA area. So they wanted to look at all GTE spend. And it was a standard fraud risk analysis. Split receipts, $74.99, round numbers, the whole kit and caboodle. And what they discovered was a couple of things. And these were gifts, travel, and entertainment of foreign government officials, so high risk under the FCPA.
Sure.
And they discovered that to make a sale, a salesman had to spend a minimum of A up to a maximum of Z. But if they got beyond the Z, there was not a sale. And they concluded that the foreign official enjoyed being wined and dined, liked the attention, whatever it may have been. So they decided to instruct the sales team They had to spend a minimum of A, but they couldn't go above Z. And they thought the sales team would go in revolt. It turned out the sales team loved it because they now had a metric by which they knew when they got to Z, if they weren't at time exactly
to move on
and quit wasting time. And it actually decreased the sales cycle because they weren't wasting time on government officials. There were some cost savings because they weren't spending that additional amount. But it was, and to me, that was an incredibly powerful story because what started out as something completely different. But the data showed, here's what you need to do for an effective sale. That to me was a very powerful message on how you can use compliance or fraud risk prevention to actually make your business more efficient. So I love those stories, particularly when they lead to that sort of insight and greater efficiency.
That risk scoring kind of framework of spend up to X and then know when to stop. Knowing when to stop is key. And even as investigators and compliance professionals, we all get stuck with having to review, whether it's reviewing in financial services, reviewing phone records, or even in compliance, just having to review transactions or high-risk transactions. How do you know when to stop? And one of the things that we've done, one of the game changers in compliance monitoring is the concept of risk scoring. And most service providers, most tools absolutely do it. Leading practice is risk scoring, which means take 100% of the data. So you're going to analyze all third-party spend or whatever is in scope. Analyze 100% of the data, and then every time a transaction meets one of your risk criteria, it gets a point. Or if you risk weight it, maybe it gets 1 point or 3 points or 5 points, depending on the severity. So if it's a round dollar payment, okay, by itself, that's not a big deal. Maybe that gets 1 point. But if it's a round dollar payment and it hits on a FCPA keyword, like friend fee or miscellaneous or what have you, maybe that gets more points. And if it was an urgent payment, it was paid within 5 days of being invoiced, or it was even paid before it was invoiced, that would give it more points. And so that idea of the more points a transaction accumulates, the higher in the rankings it goes. So I can take 200,000 or so invoices, score them from 1 to 200, and I really only need to look at the top 50 or maybe the top 100. But I know when to stop, because heaven forbid there's a huge fraud in transaction number 75,221. I'm not going to look at that because my risk indicators told me to look here. And that's where I rely on other controls, whether it's the whistleblower hotline or something else, that if fraud did happen in that transaction that was way low in my risk score, I'm going to investigate it, find out what happened, find out what risk triggers I was missing, and then I can update my model. And that's the continuous improvement. That is a perfectly acceptable, reasonable argument, if you had to explain to a regulator, for example, of a continuous monitoring program. Look, we've got these 20 or 30 tests. In my platform with KonaAI, I would say we've got 200 or 150 of these tests, depending on which module you look at. We ran it through these data with this score. It spits out these top transactions. Yeah, we can look at all of them if we want, but really, if we look at the top 50 and we don't find anything, great, move on, we're done. And that saves a tremendous amount of time and resources and helps give a sense or a peace of mind that we've got this covered. And then through dashboards and visualizations, we look at other anomalies that might pop up. But it saves a lot of time. And again, it pretty much, we talk about success stories. That's happened with all the companies that I'm working with. They all benefit from that time savings. But I don't know, what are some of the other examples that you're seeing? I've got lots of them, but anything else any other ones you want to share, Tom?
Another one that is also equally powerful to me because it's so counterintuitive is the following events. A major U.S. HVAC manufacturer, and I don't mean a window unit manufacturer, huge systems for buildings, resorts, heating, air conditioning, and ventilation. A major supplier for foreign governments and foreign government officials for building projects. They had a program where they would bring foreign officials in the United States to observe the manufacturing process and for discussions in plant on site. So it wasn't an issue of travel, but they decided that the risk was simply too high for the money they were spending. They were spending millions on this program. So they decided to stop the program. Now, they would still host foreign officials, but they had to come on their own nickel. And once again, they thought the sales team did go in revolt. But after a year, two things happened. One was this was a 7-figure spend, so there was significant cost savings. But number two, it changed the character of the people who came to the plant. Because now it was not a trip to the United States free. It was someone paying, or a company or a foreign government paying for an official to come. And these were decision makers. So not only did it decrease the sales cycle, but it increased the quality of customer who came to the United States. And typically they came to sign a contract.
Wow.
People with contract signing authority. And to me, that was completely counterintuitive. But it was because the spend they were making and the risk assessment that you've talked about through several of these podcasts, they decided their risk was so too high that they were going to discontinue the program. But by doing so, they changed the quality of the customer.
Wow.
And so that it really drove home to me, together with the first example I gave. You may go in thinking you're going to get one result. You may do it for one reason. And I don't want to say it's the law of unintended consequences, but if you keep your eyes open and you keep curiosity and rigor in your decision making, you can determine a wider variety of benefits than you may have started with.
Wow, that's really cool. That reminds me, having that transparency into the data. I've got one customer that's integrated over 19 different data sources into their compliance monitoring program. So yes, they pull in third-party payments and vendors. They pull in the due diligence work that was done. They pull in the OFAC and the sanctions lists that were done. They pull in the whistleblower hotline and investigations data that was done. And then it's a global mining and mineral company, and they have their other specific indicators and product and things coming into it. It's big. And I would not recommend 19 day one doing it, but this was something the company was ambitious, and they're bringing it in over time. But boy, the transparency that they're bringing into their business now, and identifying improper payments, but in risk scoring, is able to give their compliance team great transparency into the data that's actionable. And that's really the key. Big deal if you can just show some analytics. If you can't make a decision with it, then it's useless. And so being able to take action and identify inefficiencies, identifying process circumvention or controls, and just overall improving the business, being able to pull in those multiple data sources just really shines the light on on bringing transparency to the business. It's funny, one case, this was a large technology company. They were one of the top 10 risk scored transactions was an event that seemed strange because it was a 7-figure dollar expense that the company hosted as an event, but there was no event publicized on the internet. There was no marketing for this event. And so the investigator, was the compliance professional who was overseeing this, was like, what is this thing? And he called his counterparts in Europe where the event apparently took place, and they're like, I don't know, I can't remember what this was. And it turned into an investigation. But it's just being able, but again, it was in the top 10, or I think it was in the top 15 riskiest transactions because it hit on multiple risk triggers. That's the efficiencies in terms of spotting things quickly rather than having them come up through the whistleblower hotline.
Vince, you used a phrase I'd like to pick up on just for a few moments: multiple risk triggers. And explain why it's not just one thing or one anomaly; it's multiple.
Yeah, it really is. If you think you will not have good results if you pick one test and search for it. Now, a test like there are some no-brainers. If the bank account of a vendor matches the bank account of an employee, and in millions of dollars going through that, that's a problem. So you don't need any other risk triggers to find that one, and that's an investigation, but that's rare. But being able to really, the philosophy behind risk scoring is to say, show me the transactions that are hitting multiple high risk triggers, not just one. The way it was done before 10 years ago in Excel or in some of the old tools was auditors typically, or internal auditors, would run a whole bunch of individual tests in silos. And they would look at each individual test and say, nope, I don't see anything. But when you look at the test combined, and when you combine it with the purchase orders and the invoices and the payments and integrating them all together, that's when the transparency and the aha comes together. And really, to find improper payments, fraud, bribery, and corruption, remember, in the end, it's all about deceit. The fraudsters are going to hide their tracks. They're not going to make this open. So they're going to make it subtle. And being able to put in multiple risk triggers, multiple data sources, brings that type of transparency into play.
Vince, unfortunately, we are near the end of our time, and indeed the end of our time for this 5-part series. But before we leave, I wanted to ask you, if our listeners wanted more information on yourself, on KonaAI, or really any of the topics we've touched on, what might be the best place or places for them to go?
Please visit our website at KonaAI.com. I also invite you, if you're a listener of Tom Fox, please connect with me on LinkedIn. You'll see all the stuff that we're doing, speaking, and a lot of the thought leadership that we put out. I write for Fraud Magazine in every issue on an innovation, so that's fun. I encourage you to read those articles if you get that magazine. And if you'd like to chat, just email me, vwalden@KonaAI.com, or my head of business development, Matt Lower, MLOWERE @KonaAI.com. And I'm happy to chat. As you can tell, Tom, I love this stuff, and I love helping companies bring transparency into their data.
Vince, this has been way too much fun. We're going to have to do this again.
Yes, indeed, my friend.
This is Tom Fox again. I hope you've enjoyed this special 5-part series on the use of data analytics in a compliance program. I hope you'll reach out to Vince and KonaAI for more information on their data analytics tool. It's a fabulous tool. I know it will help you in your compliance program. If you've enjoyed this podcast series, I hope you'll subscribe, rate, and review wherever great podcasts are listened to. Data-Driven Compliance is now the award-winning Data-Driven Compliance, having won a Communicator's Gold Statue Award in 2023. This podcast is a production of the Compliance Podcast Network.